Imagine sending money anywhere in the world just as easily as you send an email. Instantly, and for just a few cents. Well, that's the big promise behind stablecoins. They're a whole new kind of internet dollar, and yeah, they are seriously challenging the very foundations of banking. In this explainer, we're going to break down exactly how they work. We'll show you the upsides, the risks, and what it all means for you.
That's exactly right. In 2025, we're way past this being some niche crypto asset. What we're talking about is a brand new payment rail. It's a whole system for moving money that operates completely outside of the traditional banks. Honestly, this is one of the biggest shifts happening in finance right now, and understanding it is absolutely key to navigating the future of money. And just a quick heads up as we dive in here. This explainer is for educational purposes only. It is definitely not financial advice. Our whole goal is just to give you clear information so you can think for yourself.
We want you to leave here with more than just information. We want you to have a framework for thinking this all through. So stick around. Later on, we're going to share a simple 3-step playbook you can use to navigate this whole new landscape.
All right, so here's our roadmap. We'll start with the basics. What in the world are these internet dollars? Then, we'll put stablecoins head-to-head with banks. We're going to cover the critical risks you have to understand. We'll look at 3 possible ways this could play out in the future. And finally, we'll deliver on that 3-step playbook.
So let's start at square one. What exactly are these internet dollars we keep talking about? Analyst, let's get a really clear definition of a stablecoin.
Okay, think of a stablecoin as basically a digital version of a dollar bill. It's a token that lives on a public, global database, what we call a blockchain. And the most important part is right there in its name, stable. It's designed to always be worth $1. So it's like it combines the stability of the dollar with the speed and reach of the internet.
Okay, so that's what it is, but why is this actually a big deal for you? Let's break down these 4 key reasons. Analyst, why don't you kick us off with speed and availability?
Of course. So first, speed. Transactions settle in minutes, not days. The system is also, it's always on, 24 hours a day, 7 days a week, holidays included. You're not stuck with banking hours. And third is global reach. You can send value to anyone, anywhere, as long as they have an internet connection. It just breaks down those old barriers of finance.
And that last one, composability, that sounds a little technical. What does that mean in simple terms?
Composability is a really powerful idea. It means these digital dollars are kind of like Lego bricks. They can just plug into other financial apps online without needing to ask a bank for permission. And this lets developers build all sorts of new tools for saving, for lending, and for investing. It really creates a more open financial system.
So where do these digital dollars even come from? How are they created? It's actually a surprisingly straightforward process. It all starts with a company called an issuer. First, the issuer takes in real assets. We're talking US dollars or short-term government bonds, and holds them as reserves. Then, for every dollar of reserves they hold, they mint or create one stablecoin token on the blockchain. And when you want your real dollar back, you just give them the token. They burn it and send the dollar from their reserves right back to your bank account. The process is just reversed.
We really believe that making smart decisions starts with having better information. If you're finding this useful, just take a second to subscribe to Smart Money. It helps us create more content just like this.
Okay, so we've covered the what and the why. Now for the main event. Let's put stablecoins head-to-head with traditional banks. We'll see exactly how they stack up on the features that matter most.
The differences here are really stark. A stablecoin transaction can settle anywhere in the world in just a few minutes. An international wire transfer through a bank, that can still take several business days. Stablecoins are available 24/7 all year round. Banks, as we all know, operate on business hours and close for holidays. And stablecoins are global from day one, not held back by complex regional banking partnerships. This isn't just a small upgrade, it's a fundamental shift in how value can move around.
And this shift shows up directly in your wallet, especially when it comes to cost. Let's make this real for a second. Imagine you're sending $200 home to your family overseas. With a traditional wire transfer, fees could easily eat up $10, maybe $15 of that.
Exactly. With stablecoins, because you're cutting out a lot of the middlemen, that same transaction could cost you less than $1. For millions of people who rely on sending money home, that difference is enormous. It means more money ends up where it's needed most. That's a powerful, practical implication.
But hey, this is not a one-sided fight. Banks still have some major advantages they've built up over decades. Analyst, can you walk us through where the traditional system still has the upper hand? Absolutely. The first big one is deposit insurance. Here in the US, the FDIC insures your bank deposits up to $250,000. Stablecoins have no government backing like that. Banks also offer strong consumer protections. If your credit card gets stolen, you can dispute the charge. Banks also offer a huge range of credit products like mortgages and car loans. And finally, their dispute process is well established. If there's a mistake, there's a system to fix it. These are features people really depend on.
Those bank advantages you just mentioned, they all exist to manage risk. And that brings us to our next critical section. Because with all the new capabilities of stablecoins come a whole new set of risks, and you absolutely must understand them before you even think about using these tools.
Let's break these down because each one of these is important. First, there's issuer risk. This is the risk that the company behind the coin doesn't actually have the one-to-one reserves that they claim they do. Next is depeg risk. This is the danger that the token loses its $1 value, maybe because of market stress or a design flaw, like we saw with the Terra/Luna collapse. Then you've got smart contract risk. This means a bug in the code could be exploited by hackers. Policy risk is also huge. A government could sanction specific addresses and freeze your funds instantly. And finally, there's operational risk, and this one is just simple user error.
And I really want to pause on that last point because it is so important. When you operate in this space, you are your own bank. If you make a mistake on the blockchain, like sending money to the wrong address, that error is very often permanent. There is no customer service number you can call. There is no one to reverse the transaction for you. The responsibility is entirely on you.
Okay, so we have this landscape of incredible innovation on one side, and some very real risks on the other. Given that tension, where do we go from here? Let's explore 3 possible scenarios for how the next 12 months or so could play out.
Based on the data, we really see 3 primary paths forward. There's about a 45% probability that the main story is just growth, stablecoins getting integrated into more apps for payments and remittances. Then, there's a 35% chance that policy and regulation become the main story. Governments step in to create clear rules of the road. And finally, there's a 20% chance of an isolated shock. This could be a major issuer failing or a big hack that really tests the system's resilience.
So what would these futures actually look and feel like for someone using them? Well, in the payments grow world, you'd start seeing stablecoin payment options in more of your favorite fintech apps. It would just become more mainstream. Now, if policy tightens, we might see slower growth. But the stablecoins that comply with the new rules would gain much higher trust. And this could attract more institutional money. And in an isolated shock scenario, you would see a very rapid flight to quality. Users would quickly move their funds to the most transparent and reputable issuers, really punishing the weaker players.
All right, we have covered a huge amount of ground here. We defined the tech, we compared it to banks, we unpacked the risks, and we've looked at the future. Now let's bring it all together. It's time to deliver on that 3-step playbook we promised you at the start. And remember, this is a framework to help you think, not a set of instructions to follow.
Here it is. Step 1 is map the job. Ask yourself, why would I even use the stablecoin? Is it for active trading on crypto exchanges? Is it for fast, cheap international payments? Or is it to access yield opportunities in decentralized finance? The job you need done really defines the tool you should use. Step 2, pick your rails and custody. Use well-known, reputable exchanges as your on-ramps and off-ramps. Then decide how you're going to store your assets. Are you going to leave them on an exchange or use a secure self-custody wallet where you control the keys? Finally, step 3, implement risk controls. Don't put all your eggs in one basket. Think about diversifying across different issuers. And most importantly, learn how to find and verify their latest reserve reports and third-party audits. This homework is absolutely essential.
So if there's one single point to take away from our entire discussion, it's this. Stablecoins can be an incredibly powerful and efficient tool for moving value in this digital age. But that power only works for you if you fully understand and respect the very real risks that we've talked about.
That brings us to the end of our explainer, but the conversation keeps going. We want to hear from you. What stablecoin use case, whether it's payments, trading, or something else entirely, matters most to you as you look ahead to 2025? Let us know what you think in the comments below.